Banking results of the second quarter are picture perfect. For the sector as a whole, bad loans or NPAs are at 5-year lows and return on assets also at multi-year highs. Actually, it's a 180-degree change for both private and public sector banks. NPAs were at ugly highs in FY18 and in FY19. And from there, they have fallen by more than half, actually, in the case of public sector banks. How long will it last? Let us turn to the previous cycle. From 2001, the sector saw a sharp decline in NPAs all the way to 2008-9. And especially after 2004, on the back of a 7 to 8% GDP growth, we saw a real sharp decline in NPAs. But thereafter, that is after 2009, slower growth led to higher NPAs. In 2016, the RBI's asset quality review, which was a forcible recognition of NPAs, pushed bad loans to shocking highs in FY18 and in FY19. But since 19, it has been a saga of improvement, as you can see. So the question we are asking today is, how much longer can the good times last? I have with me three people who have seen both cycles, albeit in different capacities. I have with me Ashish Gupta, the head of equity research, India and financials, Asia Pacific at Credit Suisse. NS Vishwanathan, former deputy governor, Reserve Bank of India, had a seminal role to play in the AQR asset quality review. And Vardhan, the banking expert, formerly with BCG, but now an independent consultant. Gentlemen, thank you very much for joining us. What is your sense? This good times that have started from about FY19, a seminal decline in NPAs, does it continue like the previous cycle? The previous cycle, with a 10-year run, FY01 to FY9 or 10, NPAs kept falling. Is it as good a cycle now?
If I look in the near to medium term, we feel fairly confident about the asset quality outlook for the Indian banking sector. I believe not just the current NPAs are low. I think the current lending standards that banks have are still fairly tight, right? And it's been my long-held belief that actually NPAs come after the period of loosening of credit standards. You pointed out very correctly to the fact that we had the AQR and post-recognition of these NPAs on the corporate side. I think another facet we can add is that during COVID, there was to some degree forced or accelerated recognition of stress even on the consumer credit side. And now we are having this period where A, there has been forced recognition of NPAs, and B, over the last few years, the credit standards of Indian banks have been tightened. This is reflected in, if you see the last 3 to 4 years, credit growth in India has been actually well below the nominal GDP growth. So I think these two definitely point to the fact that in the at least coming couple of years, we expect asset quality trends to remain very, very strong and credit costs to remain benign.
Mr. Vishwanathan, we saw a seminal fall of NPAs from a high of about 14% for the system in 2001, all the way to about 3% by the time we came to 2008-9. Now, what I'm asking is that from FY19, we have a new cycle of falling NPAs. Can this extend to a 10-year cycle?
I think the way I want to put it is we need to see this change happening from very many angles. Two parts. One, I think it is partly to be looked at what happened in the terms of recognition, recapitalization, and reforms, in the entire credit system. So I think, particularly in the public sector banks, the entire framework for recognition of NPAs, restructuring, all those things, the reforms that were brought in there, and in a way, the recapitalization that resulted post the AQR, all those things have played an important role in looking at where the banking system is today. Number one. Number two, whether we will have a repeat of the NPAs going up. I think banks, I'm sure, have learned their lessons, number one. Number two is that, the entire recovery mechanism in India has undergone a big change, including with the coming in of IBC, and a lot of issues that need to get fixed on the IBC front are being attempted to be fixed by the government. And I think, therefore, two things are important. Number one, of course, the economic, how the economy progresses is important. But I think there is even if you saw the latest financial stability report that's available, there is a clear trend in terms of stress levels being at a reasonably comfortable level. So I think the banks have to learn the lessons if they haven't. And I want to add one more picture, which is that, what used to be considered in the past as a black swan event is kind of, for one reason or the other, happening globally or in the economy at too frequent an interval to be considered black swan event.
Okay.
So I thought the banks need to be aware of this, and they need to build this into their entire capital framework, into their appraisal framework. So I would say the entire sensitivity analysis should look at what can go wrong that we haven't seen so far.
No, my question, Mr. Vishwanathan, exactly is that has both the regulator and the banking system, created long-standing institutions. And I'll tell you why I'm asking. I don't know if the data will come up. In FY01, the total NPAs of public sector banks, FY00, was 14%. And in FY18 also, it was 14.6. I mean, the cycle is, one would have thought that people would have learned their lessons. Some of the bankers were common. Some of the regulators played their innings, all the way from FY01 to FY18. But still the cycle repeated. That's why I'm asking, have institutions been built in the form of cleric, in the form of, IBC, that you can be very sure we won't get to 14 again?
I think I would say that in terms of institution building, a lot of changes have happened post-2014. I must say that, cleric is an important institutional mechanism. The tight restructuring framework that's been put in place is an important mechanism. Third, of course, is the approach of RBI saying that we don't look at ownership. So the large number of public sector banks being placed under PCA, then government capitalizing them. And I think the entire recovery framework with the IBC coming in with respect to the larger borrowers in particular, I think have a very important bearing on how things will pan out.
Fair enough.
But there are, let's be very clear, banks are in the business of taking risks.
Yes.
They must take the right risks. Okay.
Yes.
And it's possible. And what is important today, as I said, is that they must be prepared for risks coming from sources that hitherto nobody thought of.
Okay. No, I agree with you. Sir, I'll come back to you. I want to ask Mr. Harshvardhan a slightly different question. You're welcome to tell me whether you think that we are in a long cycle of falling NPAs and improving asset quality. But also, Mr. Harshvardhan, this has also been a period of perhaps highest ever return on assets announced by, say, for instance, State Bank. Since the time of its listing, I don't know the numbers before that, it's about the highest ever. So do you think even on these parameters, there is still a runway for banks in terms of margins and ROE?
So let me answer both of your questions. See, one of the factors you have to keep in mind is that the quality of NPAs in the 99 to 2001 cycle compared to 2010 cycle is very different. The first wave had what I call traditional NPAs, metals, textiles, etc., etc. The last spike of NPAs had infrastructure, power, roads, and so on. So there was a very significant qualitative difference in the way the NPA cycle panned out. Now, what has happened also, that is factor number one. Factor number two, if you look at the 2001 to 2010 cycle, actually, especially 2003 to 2008, we had picture perfect macros and the global conditions very, very benign. We had very strong growth, no pickup in inflation, therefore low interest rate, very stable currency, and there was no significant geopolitical tension to speak of. None of these things hold true today. So what has happened in the process in the last 20 years is what I have termed with a co-author consumerization of Indian banking. In 2001, if you go back, industry contributed to perhaps 70% of total banking credit. Today, it's down to 28%. And consumer credit is 30% direct and another 4-5% through NBFCs indirectly, which is 35-36%. And we haven't yet seen an NPA bust, so to say, in consumer credit. So given all this, again, I go back to what Ashish said, which is that I can't take a 5-year view. But I think next 2-3 years, we should see a reasonably stable risk profile in banks. Which means that, and the reason for that, to believe that, is that we still are not seeing any particular stress in the consumer books.
Yes.
I had thought that during COVID, we would have seen some, but we haven't. And so I think next 2-3 years, banks, at least on the NPA accounts, seem to have a reasonable run. There are 2 books that I'll watch out for. One is unsecured consumer credit, which is about 11-12% of the system, and MSME prior to the guarantee scheme, which is another 5% of the system. So about 17-18% of the book is a watch out. It's not a worry right now, but it's something you'll watch out for the next 2-3 quarters, because these are the segments where inflation would hit them. Now, coming to your question on performance, this performance has been outstanding for 2 reasons. One is credit provisioning costs have gone down. Basically, all the prior NPAs have now basically been paid for. And therefore, you see bank after bank credit costs just completely crashing. And secondly, we're at the beginning of the rate hike cycle. At the beginning of the rate hike cycle, margins widen. In the last 6 months, 2 quarters actually, we've seen loan pricing go up by about 100 basis points, and deposit pricing hasn't gone up. It has gone up by about 50 to 60 basis points. So NIMs have widened. So the net impact of both these credit costs crashing and NIMs widening is that you are seeing extraordinary ROAs. My own view on that is a little bit cautious, in that I feel the NIM widening will not sustain. Because deposit pricing will catch up, will have to catch up. We have a serious deposit shortage now. Between April and August, Latha, credit in absolute has outgrown deposit by 40,000 crores.
Yes.
I looked at the data for the last 25 years. This has only happened 3 years in the last 25 years. 2005, 2006, and 2018. And the year after, when this has happened, we're not good for bank margins. Because then deposit pricing has to catch up.
Fair enough.
So I, on margins and profitability, a little bit cautious. I think we are not going to sustain this high profitability. But on NPAs for the next 2 to 3 years, I am reasonably bullish.
Okay, so I think most of you are on the same page. But Ashish, I would still let you, comment on that. As Harshvardhan pointed out, there is Mudra loans, MSME loans, and also the ECLGS scheme kind of kicked the can forward. So do you think we can still have some disturbances in terms, and unsecured credit, as you pointed out? Do you think we could still have some increases?
I think both the pockets that Harsh mentioned are very correctly diagnosed. I think unsecured credit has been rapidly growing. The good thing is that it's a fixed rate loan, right? So the recent rate increases should not have an impact on the asset quality of these loans. So the EMI is actually not going up. The second is that it is relatively shorter tenor, right? And as was pointed out, some of the earlier problems were the infrastructure sector loans or commodity-linked loans, which really the deterioration takes much longer to come to surface. I think the good thing here is that these are all EMI-based loans. Every month you start to get some indication of the quality of the customer. And as of now, it is holding well. The indicators are good. But frankly, this is one pocket that has been growing rapidly. And as I mentioned earlier, the risk actually comes from segments that grow faster than the economy is growing. So if you see personal credit growth has been outpacing the nominal GDP growth, while the corporate credit growth has been much slower. So I think these are certainly pockets to watch out for. On the margin bit, my take is actually that like the credit cost, I think banks can thank RBI for the margin improvement that they have seen over the last 2 quarters. And part of it is the RBI moving the floating rate benchmark to external rather than PLR. And that has meant that the loan book benchmarks have moved up much more quickly than their funding cost. So therefore, with the rise in rates, we are seeing much quicker improvement in bank margins. And I believe it will last till the time RBI is hiking rates. So if over the next quarter, there is another rate hike by the RBI, bank margins will continue to move up. But yes, this will not sustain. With a lag, the funding cost will catch up and margins will moderate from the current levels. But I still suspect they will be higher than what they were 2 years ago.
I have to take a quick break and then some more systemic questions for my guests. Back in a minute. Welcome back. We have seen some spectacular results, second quarter results from the banking sector, both private sector banks as well as public sector banks. Hardly any exceptions to that. But how long will the good run continue, both in terms of quality of assets and in terms of profitability, is what we've been discussing with Ashish Gupta of Credit Suisse, NS Vishwanathan, former Deputy Governor of RBI, and Harsh Vardhan, the independent banking consultant formerly from BCG. Gentlemen, thank you for your patience. Mr. Vishwanathan, I wanted to know if in public sector banks you notice, any institutional change. After all, that's where we saw the return of NPAs to the same level that they were in 2001. But, now there are institutions like CRILIC and probably some sensitivity at the government end as well. Do you think things are different with PSU banks?
So I think I just want to continue, make a point on the earlier discussion. If you see the delta in the net profit of banks for Q2 of this year vis-a-vis last year, they have been largely due to higher NIMs, again due to higher interest earnings on the one hand, and number two, lower provisioning. Okay, both these are the two factors that resulted in the net profits being much higher in the current quarter, last quarter of this year than vis-a-vis last year. Now, all this to stay, it's important that these are not happening due to factors purely external to the banks. It's also happening because banks have internalized a lot of processes. So I used to keep saying, for example, that even when the banks, when I was in the bank, banks were joining the personal loan segment bandwagon, I used to say that, it's not a bandwagon to join. There must be processes in place. There must be back offices, which kind of are able to address asset quality, credit appraisal and things like that. So I think the banks, in my opinion, I've been out of the system for the last 2 years, but I think if you ask me, the CRILIC is an important mechanism because I think unlike a credit information bureau, the CRILIC data is of a lot more value to the banks on the one hand, and number two, I think the recovery system that has been put in place, which is the IBC, and some of the the governance reforms like moving the chairmanship to a non-executive person in public sector banks. All these things will have institutional frameworks in place. But I think I'm not too sure. So it's very difficult to take a view as to whether this will continue for 10 years, for anything for that matter. But obviously, certain reforms which are external to the banks, like the IBC, the CRILIC system, are there. So that is not in their hands to make a mess of.
I get
so
it.
What is internal, maybe they can loosen the appraisal standards. They can. Those things might happen.
Yes.
But the external systems which are helping the credit quality in particular, those are there to stay.
Again, going back to the SBI chairman, he told us that he is more sure of his unsecured credit than even his secured credit because of the AI that they have been able to put in. Mr. Harshvardhan, any thoughts on that? That although unsecured credit is growing, would you say that technology and AI and these kinds of help could lend a lasting improvement to the banking system?
My own view that, Latha, this would perhaps vary across banks because some banks may be using it. But a lot of it is just, for example, as Mr. Vishwanathan said, a lot of the external things, the credit bureau coverage has improved a lot. They cover far many more people now than they did even 5 years ago. And people are aware of not spoiling their credit scores and so on. So I think those factors have also played in. But nevertheless, while these are all fixed rate loans, as Ashish said, look, inflation pinches into household budgets. That's and savings are going to fall. So we'll still have to watch out. The other point I'll make, going back to what you asked, Mr. Vishwanathan, is that, despite all the things that we said, there is still significant risk aversion in banking. Risk-weighted asset to total asset ratio is still at 54% as of the last quarter. It was 70% 10 years ago. Banks have just far more risk averse right now. Yes. And that, to me, in the long run, if the capex cycle, etc., were to return, is not a good signal. Ultimately, banks have to take risk, right? Otherwise, who will provide credit in the economy? No,
I should be doing this discussion when there is euphoria, not when there is fear. Probably, you never know, in the next 3-4 years, we could be euphoric that India is the only game in town. You never know. Ashish, actually running out of time.
Honestly, sorry. Yeah, sorry. No, that can't happen on the back of consumer credit alone. We are not at the stage of our development where banking becomes consumer banking entirely. Somebody will have to fund capex. And I don't know where it will come from with this level of risk aversion. Yeah, so that's a macro problem to worry. How will we fund the capex? Ashish, actually, a couple of questions. I'll try and squeeze them in. Would you bet on PSU banks now because they never got a very high price to book anyway? Is it time to give them more credit for a couple of years? As well, if you can manage NBFCs, should they also not be beneficiaries? But we don't see them, at least in the stock markets.
Sure. So I think on the asset quality front, what we are seeing is a case of rising tide lifts all boats, right? So you're not seeing the improvement just in private bank, you're seeing it in PSUs, you are seeing it in NBFCs, right? I think where the NBFCs are probably struggling is on two counts. One is a lot of banks, as you mentioned, even some of the public sector banks have improved their distribution, their use of technology, and are competing more effectively against NBFCs because NBFCs were much better in distribution. So while they had higher funding costs, because of better distribution, they had a more significant share in certain consumer loan categories. And I think banks are making inroads there. The second is the macro environment. What is the market expectations on or concerns on how the liquidity will pan out? And this means that there is not as much optimism on growth for the NBFCs being as fast as it is for the banking sector. So I think that is one reason, even in our investment strategy, we prefer banks to NBFCs. Yeah.
Thank you very much, gentlemen. I tried to fit in a lot. Key takeaways, the good times in terms of ROAs, profitability, and in terms of bad loans or lack of them is likely to continue for a good 2-3 years. Perhaps margins peak off by the end of this year. For the banking system as a whole, there is some long-term improvement because of institutions like the CRILIC, which is a database of RBI, where banks have to weekly report loans that are in default, and things like the IBC. So some long-term health of the banking system is also ensured. That's the key takeaways from our guests. Thank you very much for watching this edition of Indianomics.